Of course, it also covers the presentation of discontinued operation in the statement of comprehensive income, and IFRS 5 non-current assets held for the sale and discontinued operations highlight the results from continued operations and separate them from the results of any ongoing activities. IFRS 5 came into effect on 1st of January 2005. That is, it is applicable on any statements that are made on 1st of January 2005 and thereafter. Any assets, of course, that are classified as held for sale and non-current assets that are held for sale are not depreciated, but rather they are actually measured at lower of either the carrying amount or any fair value less the cost to sale. Not cost of sale, this is cost to sale. And as I told you, it is presented separately on the financial statements. Once you've classified any asset or you have classified any unit of your business operations as to be discontinued operation, then of course you cannot present it normally as you did with in the past years. You have to present it separately in your financial positions as these are the assets that are held for sale and this is the profit or loss that I have occurred from the discontinued operation. And hence specific disclosures have been made for such presentations and whatever amounts are there for disclosures. The held for sale criteria in the IFRS 5 apply to non-current assets whose value will be recovered principally through sale rather than through continuing use. The criteria do not apply to the non-current assets that are being scrapped out or they've become obsolete or they have become abandoned. You do not confuse it, you do not misstate it in your financial statements as those assets which have become obsolete, they are about to be scrapped out, they are about to be abandoned. You cannot show it under this financial head of financial assets held for sale. Now coming down to the definitions that are very specifically provided into this IFRS. First is disposal group and the second is discounted operation. Of course, it is provided specifically under paragraph 32 of IFRS 5. That is the reason it is 5 in bracket 32. That means discontinued operation is provided under paragraph 32 of IFRS 5. Now let's talk about the disposal group. Disposal group is a group of assets that are to be disposed of by sale or any other means together as a group in a single transaction, and liabilities that are directly associated, which are directly liable, that are directly associated with those assets will be transferred in the transaction. So all those assets which can be disposed of in a single transaction, in a single account entry, let's say, then they are known as disposal groups. That is group of assets that are about to be disposed. Of course, a disposable group or a disposal group may be of a group of cash generating units, a single cash generating unit, or a part of a cash generating unit. If the group includes a cash generating unit to which goodwill has been allocated under IAS 36 impairment of assets, or includes an operation within such a cash generating unit, if it is a cash generating unit, any associated goodwill to that particular cash generated unit is included within the disposal group. Definition of the disposal group is, however, much wider than this, and it requires neither that the disposal group involves business nor that the group include any non-current assets. Accordingly, some care and judgment, of course, is very necessary when you are interpreting and applying this definition of disposal groups. Your own personal judgment or whoever is bifurcating between the disposal groups, group of assets that needs to be disposed of, personal judgment is required. Now coming down to discontinued operations. Discontinued operations are basically component of the entity or any entity that either has been disposed of or is classified as held for sale, and they represent a separate major line of business. It cannot be a ancillary kind of a business. It has to be a major line of business. They need to be or they can be a part of any single coordinated plan to dispose of a separate major line of business, and is a or can be a subsidiary that is acquired exclusively with the view to resale. I can acquire a subsidiary and my view is to resale that subsidiary in the future. That was my only point or only agenda for which I had acquired that subsidiary. So that can also come down as discounted operation. Now coming down to the classification. An entity shall classify a non-current asset or a disposal group as held for sale if its carrying amount will be recovered principally. The main principle, it will be recovered only through a sale of transaction rather than through continuing use. So my motive of earning from that asset has moved from using that asset to incur my profits or incur profits or revenue from that, to a sale. I am going to incur a revenue from that asset through sale of that asset. So my motive has changed. Any judgment can be based on this point, that my motive through which I am going to earn my revenue has changed. Before I classified it as non-current assets held for sale, my motive was to earn revenue by using that asset, and now it has actually shifted to sale of that asset, and then I'm going to generate a revenue or a loss, or it can be anything. So the whole classification aspect is very important in IFRS 5. Classification and measurement. You can say the measurement of IFRS 5 can be said as ancillary. The main part is classification. So this whole classification thing is actually divided into 6 small sub points. You can just divide the whole classification into 6 sub points. Let's start with the first one, or let's start with the let's go point by point. So for in case if an entity gets down to is very committed to sell an asset, any non-current asset that is specifically held for sale, if this is the case, then the asset must be available for immediate sale. This is a very important point, that the asset should be available for immediate sale and not any in a near future. If I am planning to sell my asset of whatever is the asset, let's say my property or any land that I have, if I'm planning to sell that land or my property, then it should be available for immediate sale. If I get a very good deal to sell the land, I should be able to provide the possession and ownership of that land to the party taking that or purchasing the land immediately. In the present condition, of course, on the present condition only. Like the present condition, of course, you can take an exception like the usual and the customary of sales of such assets. I mean, any transfer that is happening or something is taking time, that is included within that. So immediate sale can include that customary or usual time that is taken for transfer of the asset. And second, the sale, which is important, is the sale should be probable. Sale, if it is probable in an entity point of view, that means you have had all those, if you need to take permissions from your board, from your investors, or someone from your parent, whoever it is, all those permissions have been granted, everything has been done, and all the paperwork within the company is done, and that makes the sale probable. The probability of selling that asset is very high now, because all my paperwork has been done within the company. My management has given the permission, the board meeting is done, it has been come down into my reports and everything. Now the only thing that needs to be done is to locate a buyer and sell the asset. So the probability of that sale has to be very high. And for the sale to be highly probable, the appropriate level of management must be committed to a plan to sell the asset and an active program to locate the buyer, and complete the plan must have been initiated. Then further, of course, there is one more point which you can take it as per the locate in the point of location of the buyer, that the asset should be actively marketed for sale at a price that is reasonable in relation to its current fair value. Now, let's say the management is committed to sale the asset. The sale is very probable. I am going out and locating the buyer. The asset is available for immediate sale. But if I am putting a value attached to that asset, which is higher than the market value, let's say the value of my land which I want to sell out is 1 lakh, but I am demanding on an active market amount of 5 lakh. So of course you cannot classify that asset as non-current assets for held for sale. The reason is because I am not actively marketing it, and I am asking for an amount that is higher than the market value. Of course, no one is going to provide me with that. That is the reason active marketing is also a point in that. I'll tell you why is this active marketing here. The reason is most of the companies can put their obsolete uh, assets or any scrapped out assets under assets held for sale, and they can also show that my management is committed, the probability of my sale is high, I am locating a buyer, it is available for immediate sale. But since if you're marketing those things above than the market price, it is not counting to be non-current assets under held for sale. And of course, there should be no changes in the further plan, because this whole thing, this whole classification, selling and everything needs to be completed within a period of 1 year. So in 1 year, of course, the management and the business is probable enough to sell it. So no changes in the plan should take place. Now let's understand the whole these 6 classification matters on various examples that come in the real life sessions. Now, this is an example. There is a company who is committed to sell its factory premises, and it has initiated actions to locate the buyer. So my company, the management is committed. I have an asset that is available, that is factory premises, and it has initiated the locate a buyer action. Now, the entity intends to transfer this premise to a buyer after it vacates the factory. The entity will continue to use the factory for its working until the construction of the new factory building takes place, is completed. And the entity does not intend to transfer the existing factory to a buyer until after construction of the new building is completed. So the company is not intending to shift until and unless the new factory building is ready to move and to be operated. So let's see. These are the 6 point of views for classifying my non-current assets that can be classified as held for sale. The management is committed, so that is okay. Asset available, we'll come to this later. I am locating a buyer, I am actively locating the buyer. And my sale is also probable because I have actually I am under construction of a new factory premises. So the sale is probable also. It is actively being marketed because since I am locating a buyer, so of course I am actively marketing it also. And there is no plan changes in the near future. The reason being, I have a new factory building that will be constructed in a near future, let's say 2 to 3 months, and I'm going to shift it there also. But is the asset available for immediate sale? No. Hence, you cannot classify this factory premises as non-current assets held for sale under IFRS 5. The delay in the timing of the transfer of this existing factory premises imposed by the entity demonstrates that the building is not available for in immediate sale under the criteria specified by IFRS 5. And this criteria would also be not met until this construction of the new building is completed. Even if I get a firm that provides me with a purchase commitment in the near future of transferring the whole sale agreement, then also it is going to be transferred after my construction of the new building is done and I have moved and it has started operating. So it is not available in immediate sale. That is the reason I'm not going to classify this as my non-current assets held for sale under IFRS 5, and it will be continued to be shown by the actual IFRS or the standard it is in accordance to that. Let's take another example of discontinued operations, because of course assets held for sale and discontinued operations both are looked upon by IFRS 5 only. There is an entity and it is committed to a plan to sell a manufacturing unit. This is a manufacturing entity, and hence one of its manufacturing unit they are planning and they are committed to sell that manufacturing unit, and they've also initiated the action to locate a buyer. At the plan commitment date, there is a backlog of uncompleted customer orders. The entity intends to sell the manufacturing unit with its operations. This is the line that needs to be focused. The company is or the entity is intending to sell the manufacturing unit with its operations. That means any uncompleted orders or any completed orders, work in progress, whatever it is, shall be transferred to the buyer on the sale date. So again, we're gonna have that 6 points on which we'll be classifying whether it is a asset classified for sale or not. Management is committed or to sell because they've actually planned and committed and they're locating a buyer. Asset is available for an immediate sale. Immediate sale can be possible even if it has uncompleted orders. It can be sold out. I have actually located a buyer. Sale is probable. It is actively being marketed and the plan is of changes are not there. There are no near future changes in the plan. Hence, that will be actually classified under discontinued operations. The manufacturing unit will be under the discontinued operation as per the IFRS 5, and all the IFRS 5 requirements compliances will apply to that discontinued operation. Presentation, disclosure, measurement, whatever the requirements are as per IFRS 5, that will be actually provided comply to this discontinued operational unit. Now this is actually the same example, but here there is one change. The entity is intending to sell the unit only after all the operation ceases. It ceases all the operational units, all the operations are completed, orders are completed, and there is nothing backlogged, and only then the unit shall be transferred. So in this case, if the unit is transferred, in this case, just a moment, I'll be just a moment, please. Yes, I'm so sorry, there was a call. Yes. So where were we? Hanji. So this discontinued operations, this manufacturing entity, when is not intending to sell the unit until and unless it has completed all the orders, it has no backlogs and nothing. Only then I'll be intending to sell this manufacturing unit. So in that case, my scenario is gonna change. Though my management is committed, I have located a buyer, sale is also probable. I am actively marketing it in the market to locate the buyer, and I do not have any changes, but the asset is not available for immediate sale. And that is the reason this will not be classified as discontinued operations. the criteria that is set under IFRS 5 would not be met until the operations of this whole unit was done, seized and logged, and no backlogs were there. Even if the firm wanted to purchase, any firm or any entity, if you wanted to purchase also, then also it could not be sold out. The reason is it was not available for an immediate sale. So now this is an example for disposal groups. Disposal groups, of course, we have seen are the group of assets that could be sold out in a single transaction. Now, this is a fictional example. Do not take it as a real life example. It is just because company A, company B, company C sometimes becomes monotonous. That is the reason I've just used these names. It is totally fictional. It has got nothing to do with any person living or dead. So let's start. Tata Sons and Singapore Airlines on 25th of December 2019 decided, approves and commit to a restructuring operation of Vistara. Vistara is actually a joint venture of Tata Sons and Singapore Airlines. And they were committed on restructuring operations, and the Vistara was going under restructuring of it. Just hold on, because there is local authorities are going outside. Yes, let's start. Yes, so Vistara was going for a restructuring operation, and this included both the employee termination plans and the plant disposal. So there were the whole restructuring option was bifurcated. One where employees were to be terminated, and the second is where some of the plants were to be disposed of. The plan specifically provides that all significant actions to be taken to complete the plan, activities that will not be continued, including the location of those activities and the method of disposal, and the expected date of completion. Of course, the expected date of completion was within 1 year. As part of the restructuring plan, Vistara will continue to operate in existing plant until June 2020. At which time an alternative plant will be able to absorb the current plant's capacity. The plant assets shall be disposed of in a single selling event along with other restructuring actions. So the whole case scenario is, my joint venture was going under restructuring, and restructuring included disposal of the plants and also a group of assets that was included on the under the plants that was to be disposed of. But there is one thing, that the expected date of completion of my whole restructuring is within 1 year. So that means up till 25th of December 2020. But I'll be using those plant, what the current plant or where I'm working, Vistara will be using that plant until June 2020, because they have estimated that the new plant will be able to absorb the current plant's capacity only until June 2020. So this is actually my analysis of the study that says that the current plant of the current plant's group of assets shall not form a part of the disposal groups and shall not be classified as the assets that are held for sale for the financial statements that shall be prepared for the period ending 31st of December 2019. The reason is because they are not available for immediate sale. It is clearly written that operational requirement of that plant is required until June 2020. Hence, the assets shall be presented as per the new other standards in effect pertaining to the financial assets, that is IFRS 9, and also Vistara shall assess and reconsider the period over which current plant will be depreciated, and any impairment review shall also be conducted in order to have the impairment loss or gain as per the IAS 36 impairment of assets. So when we're talking about impairment of assets 30 for like under IAS 36, IFRS 5 makes a very important section of this IAS 36 into that. The reason is because if I am disposing of an asset, of course, it will be having certain impairment losses in my financial statement. It might be appearing there also. So IAS 36 will also be looked upon simultaneously with IFRS 5 as to how to treat it. Of course, we'll be seeing how it is IAS 36 is done. I mean, it is not given in IFRS 5 specifically. I've just provided a concept-based IAS 36 thing. We'll be looking it at the end of this class. Now, there is one thing that is provided under para 13 of IFRS 5, which is abandonment. An entity shall not classify any asset or any non-current asset held for sale that is to be abandoned. The reason is because its carrying amount will be recovered principally through continuing use. I'm going to abandon it at some near future, but I'll be using it. So I'm going to recover the amount, the carrying amount through continuing use. But however, if the disposal group of to be abandoned meets the criteria of discontinued operations, which is as defined that the entity shall present the entity should present the non-current assets held for sale under IFRS 5, then the entity is going to present the results and cash flows of the disposal groups as discontinued operations at the date on which it ceases to be used, and not when it I'm planning to cease the operations. The date on which I cease to use that particular unit, I cease to draw any operations from that particular unit, only then I'll be classifying it as a discontinued operation. Any decision that is taken to abandon a specific unit will not form or rather comply under IFRS 5 as discontinued operations. It is abandonment, and there is a difference between my discontinued operations and abandonment. Non-current assets or any disposal groups, that is the group of assets to be abandoned, include non-current assets that are to be used to the end of their economic life and non-current assets that are to be closed rather than sold. There's a difference between non-current assets closed, I'm closing that use of that non-current asset, and I'm selling a non-current asset. An entity shall not account for non-current assets that has been temporarily taken out of use as if it has been abandoned. This is, of course, a disclaimer there, that if some of my asset, I am not using it for the time being, I am not using it for the particular time, for the next 6 months, for next 7 months. So I cannot, of course, put those units or put those group of assets under abandonment. It is just I am not using it for some time. They are not providing me revenue for some specific period of time. It is not I'm going to abandon it. And in abandonment also, I am going to treat it as my disposal group or my discontinued operations on the date when it ceases to be used, not when I have actually planned to abandon it and planned to cease the use of that particular unit or a group of assets. Let's take an example for this. Again, this is a fictional example. Tata Group announced a plan to abandon the operation of its subsidiary Chroma on 15th of December 2019. Tata Group has determined that Chroma represents a component of the entity as defined in IFRS 5. Under the plan of abandonment, Chroma will cease to accept any new business as of 31st of December 2019. Tata Group also anticipates that Chroma will be able to wrap up the production of all the remaining orders, any ancillary operations, and will be closing down the plants in the offices in use by 15th of March 2020. Now the question is, should Tata Group classify the operations of Chroma as discontinued operations in its 31st December 2019 financial statements? I'll just go through this case study again for you to understand specifically. Tata Group had a subsidiary, Chroma, and it is planning to abandon the operation on 15th of December 2019. But it is just going to cease the acceptance of new orders on 31st of December 2019, but it shall be operational by 15th of March 2020. The reason being to wrap up the operations, to wrap up any ancillary activities, to close and complete all the orders and everything. So it will be operational until 15th of March 2020. Now, what is this effect on 31st of December 2019's financial statements of this Chroma? IFRS 5, paragraph 13 of IFRS, of course, states that while assets and disposal groups to be abandoned may not be classified as held for sale, a disposal group may be classified as a discontinued operation if the group represents a component of an entity and meets the criteria of paragraph 32. And paragraph 32 requires a component to be disposed of or classified, any asset held for sale prior to being presented as a discontinued operation. Item that are to be abandoned cannot be classified as held for sale. So it is actually not complying with paragraph 13. So it is not automatically be complied with paragraph 32. Even if it is forming a comprising of an important or an important part of the important component or represents a component of the entity, even then, if it is not complying with paragraph 13, paragraph 32 automatically gets cancelled. So how will I show it in my financial statement? It is actually abandoned and not discontinued operations. So when Tata Group is preparing financial statements for 31st of December 2019, then I'm not going to classify Chroma under discontinued operations. It is just abandonment. It will be shown as normal financial statements are presented, as any subsidiary parent relationship is presented. Now, since we have gone through so many examples and everything, so we've got a very clear pro forma of how this classification is done, whether it will be classified as a under IFRS, that is assets or held for non-current assets held for sale, or any discontinued operations. Once we have classified it, the next step is to measure. How to measure the assets? When non-current assets and disposal groups are classified as held for sale. So now I have classified my asset held for sale based on the classification points that were given. They are required to be measured at a lower of their carrying amount and fair value less cost to sell, or fair value less cost to distribute. It may also happen that if I am classifying any non-current asset held for sale, I can, instead of selling it in the market, I can also distribute it to my owners. But the cost to distribute and the cost to sell will not differ with very material differences. It will be almost equal. Let's say my entity had 6 cars that were working, that I had under the vehicles, and these non-current assets were held. Now I am planning to sell off those assets. So I have classified it as per my IFRS 5 non-current assets that are held for sale. I can also distribute it to my owners the whole classification, measurement, presentation, and disclosure will be same. It won't differ as per IFRS 5. The comparison of this carrying amount and the fair value less cost to sell is carried out on the date the non-current asset is first classified as held for sale, and then again at each subsequent reporting period while it continues to meet the held for sale criteria. Like for example, I have classified any asset. I am classifying it under IFRS 5 on 15th of September 2019. When I'm preparing my document, my financial statements on 31st of December 2019, I am going to revalue and again I am going to check for the fair value, the cost to sell, and everything. I'm going to reassess and revalue that. Any Now there are certain assets which are actually listed in the IFRS 5. They are outside the scope of IFRS 5 measurement requirement, not the classification requirement. They are just outside the scope of this measurement required that is specified in IFRS 5. For example, like deferred tax asset, they need to be measured as IAS, as per IAS 12. Financial instruments, they need to be measured and recognized by IFRS 9. Any group contracts, insurance contracts, they will be coming under the IFRS 17 or IFRS 4 criteria. So they will be measured as per the requirements of these particular IFRSs, and not as this lower of carrying amount or fair value less cost to sell measurement criteria. They're not going to fall under this measurement criteria, but they will, all the classification, presentation, and disclosure requirements of IFRS 5 will comply to those assets also. When classified as held for sale, these scoped out non-current assets will continue to be measured in accordance with the applicable standard before they were classified as held for sale, although the presentation and disclosure requirements of IFRS 5 will apply. So when I am measuring my assets, non-current assets as per IFRS 5, there are certain detailed, certain requirements that are that needs to be followed. Like the carrying amount of the non-current asset is measured in accordance with the applicable IFRS immediately before initial classification as held for sale. For example, I have a property, plant, and equipment, and I have accounted that for that using the revaluation model in accordance with IAS 16. Would be revalued in accordance with IAS 16 only immediately before I am classifying it as an held for sale asset. Now there is one point that needs to be focused around here, is that the assets, if they are within the scope of IAS 36, IAS 36 is impairment of assets. If there is any indication of an impairment loss, the recoverable amount of the asset needs to be calculated, and where required, if required, this impairment loss that is counted as per IAS 36 needs to be recognized in accordance with IAS 36. Although this IAS 36 can specifically exclude from its scope assets clarified as held for sale, it still applies immediately before initial classification as held for sale. So as I told you, IAS 36 is an integral part for calculation and measurement purposes of IFRS 5. If the carrying amount of my asset that is determined in accordance to IFRS 5 exceeds the asset's fair value less cost to sell, an impairment loss is recognized to reduce the carrying amount to fair value less cost to sell. For example, immediately on classification as held for sale, and at each subsequent reporting date, my property, plant, and equipment, which was previously measured by IAS 16, is remeasured in accordance to IFRS 5 at each reporting period date. So let's say my property, plant and equipment's carrying value is 20 lakhs, but my fair value less cost to sell comes down to 18 lakhs. Then I'm going to recognize impairment loss of 2 lakh for that to bring my property, plant and equipment at an amount, at a carrying amount equal to or less than fair value less cost to sell. Again, there is one more requirement that says if once I have classified any of my asset held for sale, that non-current asset will not be depreciated any further. I'm not going to depreciate or amortize that asset any further from the date I have classified it as held for sale. Again, there is one more requirement that says any gain that should be recognized for any subsequent increase in the fair value less cost to sell of an asset, but not in excess to the cumulative impairment loss recognized in accordance with IFRS 5 or in accordance with IAS 36 till date. This says that any gain which I am recognizing by subsequent increase until I have sold it, let's say for the period of 1 year until I am going to sell that asset that is held for sale, and if there is any increase in the value of that asset based on any based on the market value or due to any other reasons, then only I am going to increase the value of the asset up till my impairment losses cumulative means all the impairment losses for that particular asset that has been recorded till date, up till that impairment loss only I can provide the gain. So that is an strictly stringent gain, or let's say a restricted gain that will be followed. Let's say my increase in any asset that is held for sale due to any market changes or something increases by 1 lakh, but my impairment losses to that particular uh, asset that I have recorded cumulatively, like cumulative impairment loss that it till date is only 60,000, then I can only increase the value up till 60,000 and not 1 lakh. The reason is my impairment loss cumulative is only 60,000. You can also see it, you can only reverse the amount that is actually recorded. Just keep that in mind. Only reversal of that only particular amount is allowed that is recorded in your books. Nothing new can be done for the assets that is actually held for sale. So before this presentation, let's move down to an Excel example. So this is my Excel example. Example says that a freehold property was originally acquired for $5 lakh. Some years later, after cumulative depreciation of $1,20,000 has been recognized, and the property is now classified as held for sale. At the time of classification, when the date when I'm going to classify it as held for sale, the carrying amount is actually 3,80,000 and fair value is $6 lakh, and cost to sell is estimated to be $2,05,000. At the next reporting date, the property market has declined and fair value is reassessed at $5,30,000, and the cost of to sell is of course again estimated, and it has come down to $1,55,000. After all these effects, subsequently the property was sold on 25th of February 2020 for $3,82,000. So let's start with on 1st of June 2019, what was the effects? The carrying amount was $3,80,000, fair value was 6 lakh, and the cost to sell is $2,05,000. Just a moment, please. Please hold on. Yeah, is the Excel visible to you people? Okay, now, so again, I'm going to repeat it because I suppose the Excel wasn't visible before that. Maybe some issue of this screen was there. Yes, again, I'm going to repeat it. There was a freehold property which originally was acquired at a cost of $5 lakh. And after some years, after this accumulated depreciation and everything of $1,20,000, it was classified as held for sale. Now, at the time of classification as held for sale, the carrying amount was, of course, $3,80,000, which is $5 lakh minus $1,20,000. So this was the carrying amount that was in my statements. The fair value that was assessed was $6 lakh. The cost to sell was estimated at $2,05,000. Now, on the next reporting date and before it was actually sold, but after it was classified as held for sale, the property market declined. It almost crashed or something happened. It declined, and the fair value was reassessed at $5,30,000. And again, since the property market declined, the cost to sell of that property also got a new estimate of $1,55,000. And subsequently, after all these happenings, the property was sold on 25th of February 2020 for $3,82,000. Let's come down to the calculations. On 1st of June 2019, when the asset was actually classified as held for sale, the carrying amount in the books was 3,80,000, and the fair value less cost to sell amount was $3,95,000. Now, since I have classified it as held for sale, I'm going to measure it at lower of carrying amount or the fair value less cost to sell. So out of 380 and 395, my lesser amount is $3,80,000. I am going to take this amount. I'm going to measure my asset, that is property held for sale, at $3,80,000. Now, on 31st of December, we saw that the property market declined, and now there was a different fair value and a different estimated cost to sell price. So we are going to, on 31st of December, of course, I am going to reassess the amount of my asset held for sale. When I'm going to assess my property held for sale, I assessed a loss that will be showing under my P&L account of 5,000. 5,000 came by 375,000 minus 3,80,000. Sorry. So I have actually incurred a loss of 5,000 in my P&L account. Now, on 25th of February 2020, when the asset was actually sold out, I will show a gain on the sale by 3,75,000, 3,82,000, the sale price minus the carrying amount of my property. So it will show me a gain on sale of $7,000. Any doubts in these numbers that have been calculated or in the uh, case study? If anyone can please ask here. I am stopping here for a minute. You can type your questions down there in the chat box. Anyone? So I suppose there are no doubts in this Excel example. We can move forward to the next one. Now this Excel example basically takes into care of this impairment losses, that is IAS 36. The case study says that there was a property that was originally acquired at 4 lakh dollars, and some years later, after a cumulative depreciation was accumulated depreciation was $1,10,000, and an impairment loss to that particular property was $35,000, which came down to a carrying amount of that property of $2,55,000, and it was actually held for sale. Mean the property was classified as held for sale. Now, on the date when I classified my property as held for sale, the carrying amount was $2,55,000. The fair value less the cost to sell was assessed at $2,50,000. So accordingly, as we measure this, I'm just going side by side because it includes 2-3 calculations. That is the reason I'm not just finishing the case study and then going to calculation part. We are just going side by side. When I am classifying this asset held for sale, I am going to measure it at any price lower of either the carrying amount or my fair value less the cost to sell. Here, my carrying amount that is showing in the statements is actually $2,55,000, and the fair value less cost to sell is $2,50,000. So I am going to write down classification as held for sale of 5,000, and the property will be carried out at 2,50,000. I'll show this calculation here. Carrying amount is 2,55,000, but my fair value less cost to sell is actually 2,50,000. So I'm going to measure when I have actually classified it held for sale. So I'm going to measure it as per this amount. If it is not visible, yes, I'm going to classify my asset, that is the property that is held for sale. I am going to measure it at the lower cost, that is the fair value less cost to sell is a lower amount, that is $2,50,000. That is the reason I will be showing this amount in my statements hereby, but it is already visible at 2,55,000, so I cannot just come down to 2,50,000 without any effects. So I will write down this value of property by 5,000. I'm going to write down the property value by 5,000 and shall show it by 2,50,000. So I'm going to show an impairment loss of $5,000. $5,000 amount I'm going to show. in my statements on the date when I am going to classify it. Let's say the case study does not specifies the date. Yeah, on any date when it was classified. Let's say I classified today. On today's date, I'm going to classify and as an asset held for sale. So on 12th of May 2020, I'm going to show an impairment loss of 5,000, and I'll be revaluing my property amount by $250,000. The principle used will be the measurement principle under the IFRS 5 standards. That is the reason I didn't do the calculation here. I wanted to specifically show this impairment fair value and the carrying amount. If my fair value amount is less than the carrying amount, because if my carrying amount is less, then it is okay. I do not have to do any transitions, any changes in my statements. But when my fair value less cost to sale amount is lower than the carrying amount, then I will have to show certain changes. I'll have to show the transition effects. Let's carry on. Accordingly, the initial write down on classification was held at $5,000, and the property was carried at $250,000. On 31st of December 2018, property market improved and the fair value less cost to sell was reassessed by $265,000. Now I have reassessed the cost of my property to $265,000. It has actually improved. My property market improved, and due to any reason, I have actually uh, got the value, fair value as the cost to sell of my property to $265,000. So I am actually having 2,90,000 will be my, that is, I'll show how this amount came. These are the calculations. So impairment loss recorded till date will be 35,000 plus 5,000 minus 15,000. That is the reason it is showing $25,000. A restricted gain of only 25,000 is credited to the profit and loss, because I had very specifically specified that it is there is a detailed requirement for the measurement purpose in my IFRS 5 that I can only reverse the amount on gain up till my impairment loss and not beyond that. My impairment cumulative loss up till 1st of June 2019 was 35,000, which was recorded earlier, and 5,000, which was here. Impairment loss of 5,000 again, that was recorded. So a total of 40,000 impairment loss was only recorded till date. So I can only reverse up till that amount. 15,000 was already recorded in profit on 31st of December, and the remaining 25,000 amount can only be credited in my PNL, not anything beyond that. So when I add to 25,000 to 2,65,000, I am getting a property carrying amount by $2,90,000. Now on 1st of July 2019, the property was immediately sold at 3 lakh cash, $3 lakh cash. So I got cash for $3 lakh and a gain of $10,000. Any doubts in these? Because these were very basic, simple calculations where all the just PNL effects are going to have, I'm going to have PNL effects and any impairment losses that I'll be having. In case anyone has a doubt in this specific Excel example. So I'll be moving forward with the presentation and disclosures requirement. Let's come down to the slide presentation. Now, second is, I hope in case the presentation view is not available, please just tell me, because I've moved down to the presentation view. If it is not visible, do let me know. So now, after I have classified, measured, and jotted down my amounts, recorded my amounts, the next thing that is very importantly provided under IFRS 5 is the presentation and the disclosure requirements. Any entity who has classified and measured any asset or any asset under non-current assets held for sale, or have any discontinued operations or disposal groups, or any distribution, any asset that are to be distributed to the owners, shall present and disclose the information that will help or enable the users of the financial statements to evaluate the financial effects of any discontinued operations or disposal of the non-current assets. What is the financial implication? What is the result on conclusion of my discontinuation of any unit or any operation or disposal of my non-current assets? What are its implication on my financial position? It will be this presentation disclosure requirements will help the users to enable that and see the implications of that. Any entity shall disclose the discounted operations under the statement of comprehensive income as a single amount that shall be comprising the total of the post-tax profit or loss or discontinued of the discontinued operation. Along with that, post tax gain or loss that is recognized on the measurement or to fair value less cost to sell, or on the disposal of the asset or the disposal groups. So the first is whatever is the post tax gain or profit or loss on my discontinued operations, and second is the post tax gain and losses that are recognized if I am measuring my assets held for sale at fair value less the cost to sell. The reason is, if I'm valuing it at my carrying amount, it is not going to have any effect. But if I have to measure it because it is lower, the fair value less the cost to sell is lower than my carrying amount, then I will have to show the implications of that also. But all of this will be shown as a single amount under the comprehensive income statement. Also, when I am disclosing, this was the presentation, when I'm disclosing, an analysis of this single amount shall also be provided specifically, that shall give an insight to the users of the information into the revenue, expenses, any pre-tax loss or profit of the discontinued operations, that will provide the calculations of the gain and losses that have been calculated, post-tax gains and losses that have been calculated if my assets have been measured at fair value less cost, or any related income tax expense that I have incurred while calculation of my discontinued operations amount, or my non-current asset held for sale amount recalculation or measurement. Any amount of income if I am incurring from the operations, that is the continuing operations, and also from the discontinued operations, that is directly attributable to the owner of the parent. Of course, the continuing operations amount of income is going to attribute to the parent only, but any income or post-tax, any gain or losses that I am incurring from discontinued operation also, I am going to discontinue the operations. Any amount of loss or gain that I am having, it is directly attributable to the owner, that is the parent, or if in a parent and subsidiary relationship. The effects in the cash flow will be the net cash flow that is attributable to the operating, investing, and the financing activities of the discontinued operations will be disclosed in a under discontinued operations head. Now the disclosure presentation is this, but in any disclosure related to these amounts will be presented in the notes to financial statements. This is the assets and liabilities if I am having any group disposal that are held, group disposal of assets that are held for sale. This is how they'll be presented differently in my financial statement. I am going to group it in a totally different way. Like here I have goodwill, property, deferred tax asset, inventory that has actually attributes to a discontinued unit, operational unit that I'm going to discontinue. So these are the group of assets that shall be disposed of. They are classified as assets held for sale. And out of that, I am also going to attribute the liabilities that are directly associated with these assets only. Any liability that is associated with these assets only, I shall be classifying that totally in a different under a different head of my financial statement. They should not be presented along with the other assets or something. Other assets and non-current assets like property, plant, or whatever the head these go to. You have to present it separately in this manner in your financial statement. So this was all from the presentation and disposable group. Now, as I said, the asset impairment for all those people who were not able to understand what does asset impairment and everything was, and for those people also who had this asset impairment was only to be done if I am going to classify it as an asset. Of course, the people might have understood what is asset impairment from the Excel example. Now, there might be in the past examples that it's seen on this slide that were there were certain assets, certain operations, certain group of assets that were that complied with all the parts of classification, but except one, like immediate sale or something. So if any one of my classification aspect doesn't fulfills and my asset do not come under the criteria of asset held for sale for that period, for particular period, but of course I am going to have, I am having that intention to sell it in the near future. It might be available for an immediate sale in the near future. So how I'm going to treat this IAS 36? It is not necessary that I'm going to treat this IAS 36 requirements only when I am going to hold these assets. I'm going to classify the assets held for sale. If any of the assets fail to meet the criteria that should be classified for the classification, if any of the assets they do not meet the criteria that is specified under IFRS 5, then also you can perform an review of impairment losses on your assets or on your group of assets. When an entity, of course, have indicated that it is intending to sell the asset rather uh, at a given point or on any very near future, but it couldn't be classified under the IFRS 5 criteria because of certain reasons, the entity should on any way consider this to be an impairment indicator under IAS 36, that is impairment of assets, which would be required to which would be required by the entity, which would be performed by the entity which would be performed by the entity to review any impairment loss review. Like in our past Excel example, we had seen we had to provide for the impairment loss on the date when I classified it as an uh, asset held for sale. But in case if that property couldn't satisfy my classification criteria, but at some near point of future I might be make it available for sale, I can fulfill that criteria, maybe immediate sale or a buyer location or any marketable attribute or something like that, if it fulfills in the near future, because of course I'm intending it to sale. So if the classification criteria will be met in the near future, you can anyway perform your impairment loss review so that you do not have to perform it on the date of classification when it is classified as held for sale. IAS 36, of course, notes that the fair value less cost to sale of an asset to be disposed of uh, will often approximate its value in use, as the value in use calculation will consist mainly of the net disposable proceeds, which is very obvious. This is because the future cash flow from the continuing use of the assets until its disposal are likely to be negligible. So this is provided under the IAS 36 impairment of assets. So in case if any of my asset fail to fulfill the criteria of my IFRS 5, but anyway I'm intending it to sale, if it is not fulfilling the criteria, let's perform the impairment loss review so that on the on the date when it is classified as held for sale, I will not have to give or pertain for any impairment losses. I will not have to record it on that date. I can have a carrying amount that is either equal to or is less than my fair value less cost to sale. So no provision had to be made on the date of my classification. So this was the only concept of impairment assets of IAS 36 that was pertaining to IFRS 5, and that I intended to just inform you about. That was the only concept that I wanted to. Rest we gonna see in the IAS 36 class, but of course we'll be, since we are talking about the impairment of assets, a small review was important of this. So any questions regarding the examples or regarding any concept out here? Please do type your questions under the chat box, while please allow me to have a glass of water. So I suppose there are no questions out here. Anyone who if find